All right, I want to welcome everybody to another Q&A live stream. Thank you so much for joining today, and appreciate you guys being here. Uh, you know, I I really want to build a culture of people who love to understand things, and that's my purpose for hopping on these things. Is I want to make sure that there's just understanding and there's access to information from somebody that would be able to explain it in a simple way, or at least somebody that you have trust with. So, these types of things are important for me. I love to make time for them. And as we get more and more demand, these things can become a little bit more frequent, or maybe I would do them every 2 weeks. And so, I appreciate the people who are here. I appreciate those who send me questions and give me an opportunity to, look into some things that are really prevalent for you at this time. So, this version of our live stream, I'm definitely going to get into questions, but I also wanted to make sure that I gave you guys some tips for a really effective tax season. As CPAs are becoming more and more in demand, more busy, and there's a lot of frustration out there in how we work and maybe turnaround time or what our processes are. I just want to give some pro tips on how we can have the most effective and efficient tax season. So, as you guys are well aware, tax season is underway. We started filing returns. I'm electronically filing returns already, and it's been a great start. I wanted to really emphasize that in the email that I sent earlier. Hey, Johnny, I wanted to make sure that you guys know that, like, I feel that you guys are hearing loud and clear, how important it is to get stuff in early. I really appreciate that. We're loaded up, and that is such a great start. So, really appreciative of that. So, pro tip number one when it comes to tax season is, if you're somebody that likes to get your tax return done, if you have a business by March 15th, or if you have a personal return by April 15th, it's super important to be in the early crowd, because we get a big wave of stuff over the next 3 weeks. And if you're coming around on March 5th or March 10th and you want to make the March 15th deadline, it is really hard to do that. What's up, Al? What's up, Colton? Welcome, guys. Appreciate you being in here. And so, getting in early is definitely something that is really, really important. Once we kind of get everything in, we start working, I've got some more tips for you guys that really help this process move along. And the first tip would be, once your stuff is in, would be to respond to the tax preparer as soon as possible. That is something that I probably do not emphasize enough and haven't emphasized enough, because here's what ends up happening is we end up getting, maybe 30 or 40 returns that we start working on. And what we do is we start working on them, and then we send out questions. And we just wait for answers on those questions. We start working on something else. And what ends up happening is we may be working on 10, 20, 25 projects all at the same time. Well, what we like to do is finish stuff so that we can move it out and get it off of our plates. And so if I'm working on a return and I send you a list of questions, if you wait 2 or 3 days to respond to those questions, I would have touched 10 or 20 other projects in between that 2-day period. But if you respond to me quickly and I maybe get an answer in a couple of hours, well, then I'm sitting there, I'm like, well, I maybe touched another project, but wait a second. Now I have all the answers to that project. I'm going to jump back into that project, finish it up, send it out, and get it done. And so it's fresh on my mind. I know exactly the 1, 2, or 3 things that I need to do to wrap it up, and now I can get it done. So responding quickly is something that I know it's hard, and I know taxes is something that we don't like dealing with, and is sometimes very tedious, and there's work involved in it. But if your goal is to hurry up and get it done and get through it, that's really, really helpful for your preparer. All right, what's really helpful for me is after I've reviewed the return and I've sent you the return and I've sent you an invoice for the return, that's the last steps before we e-file it. So you look over the return, and one thing that I will always say is never, as much as I want to be 100% accurate and completely trustworthy, I always want anybody that I'm doing a tax return with to make sure that they've looked at the return. I understand the return may be gibberish, but sometimes somebody changed an address and didn't tell me, or maybe you've noticed something that seems off, or when you're scrolling through the expenses, maybe you're like, oh, I forgot this. And so you know your situation better than anybody. What we're doing is we're preparing the forms, but it's really, really important that you give that return a look timely. And then once you got your thumbs up and you're okay with everything, to sign off, pay invoice. Once that happens, I end up e-filing the return, and then we're done. And once we can cross that off our list, that's really, really helpful for us to be able to kind of manage that workload and get through stuff. What happens a lot, though, is, I'll get around to signing it, over the weekend, and then the weekend passes and you forgot, and it's sitting on our list, and then I have to spend time, hey, just a reminder, or some of that type of stuff. That's just extra things for us. So I'm pushing for some tips here that are going to help with getting it done, getting it wrapped up, and then not having to worry about it anymore. That is the biggest thing there that we want to focus on, is not having to worry about it. But anyways, for the most part, everybody does a really great job. And, I'm sure if you're listening to this and you work with other accountants, they will appreciate this same advice. We're kind of all cut from the same cloth when it comes to, how we work and how we operate. And so, those are kind of my pro tips, is just being really, really assertive with, the needs of the tax preparer and that sort of stuff. And hopefully some of the things I shared are some things that you hadn't really thought about before that way. All right, I'm going to get into some questions, and if you have questions, feel free to post them into the chat. I'm happy to go through the chat. I see a few of you guys in there. I do have some questions when it comes to when it comes to some of the Secure Act. I have some questions when it comes to home equity lines and stuff like that. All right, Colton wants to know about the gray area in tax. There's definitely a gray area in tax, and when you have that gray area, what the gray area is when there's not a lot of IRS correspondence on how to treat something specific. So over the years, of course, you're going to be in a spot where maybe there isn't a lot of guidance on certain things. And if there's not a lot of guidance, then a lot of times what we do is we look at the risk exposure of the individual. Sometimes people want to push the envelope. Other times people don't want to push the envelope. What I want to do is I want to make sure that you don't get in trouble with the IRS. And so I'm not going to maybe allow you to push that envelope too far. And what I'm going to do is preemptively talk to you about the types of things that you're wanting to do and how to make them deductible. So an example of that would be travel. A lot of people want to deduct their travel. And when you say, well, what's the gray area in travel? They're like, well, what if I go on a trip from Thursday to Sunday and I hang out on the weekend? Well, then I want to write off that entire trip. Well, what I'm going to tell you is, if you go Thursday to Sunday and you don't work over the weekend, then you're not going to be able to write off the whole trip. But if you end up working on and staying till Monday, and you work Thursday, Friday, and Monday, then you can write off the entire trip no matter what you did over the weekend, because your work is bookended by the weekend and you had to stay. So something like that would be, in the, would somebody say, oh, well, that's kind of like a gray area, or how to figure out how to expense all my travel? I want to give you the actual way to do it, instead of having you do something where you say, well, I'll just tell the IRS that I worked on Saturday and Sunday, and try to deduct my entire trip. Now, I want to give you the way to actually do it in a legal way. All right, hopefully that kind of makes some sense. All right, let's see. I'm apparently bad at real estate, and it looks like I have a 75K loss on a building I sold, including some repairs and architectural work for the rehab that got killed by COVID. All right, would you review the losses and backup and make sure that I have the right deductions and receipts? Yeah, 100%. So, this happens. This happens. I mean, during COVID, definitely there was people who were affected by it, and the market was affected by it, because we ended up, spending so much money, government money, and printing money. The interest rates went up to combat inflation, and there's just a lot of things like that. Sometimes there's stuff that's really out of our control. So don't be too hard on yourself, Al. But certainly, if you have a spreadsheet, or you have a list of receipts, and you want us to like kind of go through and check and cross-check and make sure that your calculations are correct, that is definitely something that we can do for you. All right, let's see. I bought a home that I live in with an LLC. Can I write off all the repairs and remodels that went into it? If it's your personal residence, no. What will happen with your repairs and remodel costs is they will be added to the basis of your property. So, if you live in that home for, let's just say, a year, and you fixed it all up, and you paid $300,000 for the house, you're going to end up with, $50,000 in remodeling costs. There's nowhere on your personal tax return that you're going to be able to just like take a $50,000 loss on that. But what would end up happening is you would have a $350,000 basis in that house. So if 2 or 3 years from now you ended up going over and selling that home, then you would have $350,000 as your basis, which is the purchase price plus the remodeling costs, and that would be what your capital gain is calculated off. So if you sold it for $450,000, you'd only have a $100,000 gain on that. So it's not that all of it's lost, but just owning your house and living in it in an LLC, that's not the thing that like suddenly allows you to be able to just like have deductions for that. You would have to have income to kind of offset that. Now, if you ended up saying to me, I bought a home in an LLC that's a rental property, now we have a different conversation. So, just keep that in mind. Mr. Who Won What? All right. All right, let's see. Let me get to a couple other things here. All right, so let me just talk a little bit, have a little bit of conversation about mortgage debt. So mortgage debt is something that was part of the original Trump tax plan. It used to be that you could have debt up to $1 million, and that you could write off your mortgage interest up to $1 million loan. That number ended up moving down to $750,000 and about 4 years ago. So if you've got a loan in the last 4 years, if you're under $750,000, you really have nothing to worry about. But if you're over $750,000, there's a little bit of a calculation on how much you can deduct. That's the easy part. All right. Where it gets a little bit tricky is, let's say you're refinancing properties. And let's say you refi your home, and you have, and you take cash out of it. Let's just say you had like a $300,000 loan. It's now worth $500,000, so you refinance it, and now you take $100,000 of cash out. What happens with that? if you have that $100,000 of cash now, it's not like taxable income to you or anything like that because it's just debt. But it depends what you use that money for. If you take that 100 grand and you go, use it to pay your groceries because eggs cost so much now, you can't deduct that. That's just personal interest that is similar to a credit card or a loan on a car. You're not going to be able to deduct that. But if you take that 100,000 and you go invest in into a cookie shop, and you start building out a business with it, you have that 100K now that is used for investment. There's a separate line in itemized deductions called investment interest expense. All right, and you take the interest from that 100,000 and you would put it in investment interest, not your normal mortgage interest. Now, the reason that it's a separate line item is because there's some limitations to it. In order to be able to deduct investment interest expense, you have to have investment income. So if you have interest, dividends, capital gains, and all that sort of stuff, then your investment interest is going to be allowable as an itemized deduction. Now, if you use that 100,000 and you renovate your own house, your personal residence, kind of like the question that the guy asked earlier, if you end up doing that, you can write that off as regular interest as long as you have, as long as you're under 750,000. So, something that kind of happens sometimes is that, maybe you're a real estate investor and you have your personal residence that has equity in it. You take the equity from your personal residence and you go get a rental property with it. Well, that's great and stuff, but there still has to be that split. We still have to say, okay, some of that is investment interest. All right, so now fast forward, you're on to, rental property number one. And, you do the same thing. You take money out of rental property number one and you go buy rental property number two. What's happening here is you're going to have debt on each property, but you're also going to have investment interest in other stuff. So what we end up doing is, it gets a little tricky sometimes, but you got to calculate, and figure out which portion of all of your debt is going to investment purposes. And when you're doing that, you're still getting a deduction for it as long as you itemize, but it's going to be on Schedule A. If you use your personal residence. If you do it through a business, let's say, and you have like an LLC that has the rentals, we create a separate line that on that is specifically for investment interest expense, and you have to do some figuring on that to make sure that you're allowed to actually take those deductions. So it does get a little bit tricky if you kind of keep doing the refi thing and kind of reinvesting it to other stuff. But I do want to emphasize that you don't just put it on the regular mortgage interest line on your rental schedule if that's what you've done. All right, can you go through the pros and cons of the various tax strategies you can use to transfer money to grandkids? So open a 529 college savings plan, or something like pay your grandkids through your business. Okay, so the first thing that I'll talk about is gifting. All right, so gifting is a great way to reduce your estate. In 2023, you can give $17,000 to, like, let's say each of your grandkids. That could be put into a 529 plan. It could be put into a savings account. That doesn't necessarily matter where you put it. But if you've got money that you want to do that with, that's 17 grand. You can give 17 grand. If you're married, your spouse can give 17 grand. So there's good opportunity for you to whittle your estate down quite a bit if you want to avoid those estate tax limitations upon death. If you have a an estate that has over $24 million in, real estate, cash, stocks, and all that kind of stuff, you do want to start thinking about how to reduce that estate and how you could push some of that money down before that death tax kind of kicks in. But you have to have over $24 million in order for you to really worry about that. If you're married, filing joint. If you're single, it's 12.06 million before you have any issues with that sort of stuff. But reducing your estate can be a really important thing because estate taxes are like 35%. So that's a good one. Another thing that you ended up mentioning was paying your grandkids. A lot of times people like to pay their kids when they want a tax deduction, so they'll pay them wages. And, I think one of the things that a lot of people say is you'll see all these TikToks and things like that, or Instagram posts or Facebook posts where people say you could pay your kid $12,950 in 2022 and not pay any taxes. However, it's really, really important to know that if you're going to pay somebody money for services, you can't just give them $12,950 for doing nothing. They actually have to be working. It has to be documented. And, you're not going to pay your 5-year-old $12,000, for maybe picking up trash around your office once a week. Like, that's not necessarily reasonable for, the age, the abilities, and all that sort of stuff. So, a lot of people kind of get that one wrong when they're looking at paying their kids and how to pay the kids and that sort of stuff. But yeah, I'm definitely a fan of reducing your estate if you're in that spot where you need to do that. All right. Let me just kind of get some clarifications here. It looks like a couple comments here. If you have a renter that's in the basement and you spent that $50K improving your basement, and maybe you live upstairs and your basement is kind of like a rental that you've split off, there's definitely, some ways that we can work through some of that. I mean, you're going to depreciate your house, and there's a way to offset some of that rental income from the basement. So good clarification on that. There's definitely a discussion to be had on that, and definitely some calculation that comes along to kind of splitting utilities and splitting property taxes, and how long did they live there, and what's the square footage of the house, and that sort of thing. So definitely some things there that that would be important to kind of consider and talk about. All right. Let's see. Allie wants to know, can you please explain how the conservation easement will work? All right. So, well, actually, you know what? Let me get to that in a second. $750K, that limitation that I told you about for mortgage interest, that's for your primary residence. If you have investment debt, it does not count towards that. So I do want to have a separation there. If you have investment properties, you're going to get over $750K in debt pretty dang quick. So investment debt, no. If you have a rental property that, let's say you have a commercial building that you rent out and your debt is $2 million on it, you can write off all the interest on that. Thanks for clarifying that, Garvin. Great question. All right, let's see. All right, let's talk about this conservation easement. We'll get into some of the other stuff that's there. All right, the conservation easement's a tax planning strategy that I worked pretty hard on with the end of the year with my high-income people. A conservation easement is an investment into land, which is then turned around and given to charitable purposes, conservation purposes. So no one can ever develop on that land. So what ends up happening is you put $100,000 in there, they go get the land appraised and looked at. This is what the land would be worth if it was developed, and they say, okay, it would be worth 4.5 times what it's worth right now if it was developed and there was a housing project that was put in, or a golf course or something like that. What happens is you get a charitable donation for the fair market value as if it was developed. And what ends up happening is it's a really, really great tax planning strategy. How does it work? What ends up happening is when you make that investment, you become part of a partnership that's going to own this land. So whoever you ended up doing this with is going to give you a K1 that has your share of the deductions, and they're going to give you all the attachments that go to your tax return. So we have to fill out like an 8283 because it's a non-cash gift that's over $5,000. That has to be signed. We attach the appraisals and the development plans and all that kind of stuff to the tax return so that the IRS kind of sees the justification and the basis for that deduction. It's a really, really good strategy. But you want to make sure that you're working with really, really good people on this because it's really easy to screw up, and it's something that the IRS likes to target. Now, I will say that if you've invested in an easement before, it's going to get harder to do that going forward. In this last, big bill that President Biden signed, they actually limited our ability to be able to do conservation easements because it was such a good tax loophole. And so going forward, you have to be on historical land in order to be able to conserve it. You can't just take any tract of land and do it. And so there's going to be some more limitations on that. But Allie, within the next month or so, you should be getting a K1. And when you get that K1, you just send it off to us, and we'll make sure that all the documents and disclosures and everything like that are properly done on the tax return. And that's really all you have to do. So right now, you're just waiting for the K1, and you'll probably end up getting a bunch of attachments that go along with the K1, and you're just going to give us that big package. All right. Al says, and let's see, how do I document investment interest? All right, usually what we're going to do with investment interest, and sometimes this could slip through the cracks, so I'm glad you kind of asked about this, but a lot of times we get these mortgage statements, 1098 mortgage statement. I mean, we're not necessarily in the know on if that was refinanced or anything like that. So if you did have something that was refinanced, then it's important to tell us about it, and what we'll do is we'll help document what the number should be. The most important thing for you is to know what you spent it on. So because really it's just going to be it's going to end up being a percentage. So if you're like, hey, I kept half of it for my own personal spending, the other half went off to this investment. Well, if you have $10,000 of interest on your mortgage statement, then we're going to say, all right, $5,000 was personal, $5,000 was investment interest. All right, really good question. All right, let's see. So, somebody said, can I somehow set up a self-directed IRA for my grandchildren? If yes, how can I fund it? And is it more advantageous for a traditional or a Roth IRA? With young people, a Roth IRA is the best way to go. All right, because long term they're going to get growth on it, and you want it to be tax free. So that's a straightforward one. Now, to answer the question, can you set up a self-directed IRA for the kids? You can. Like, there's a way for a kid to have an IRA. The hard part is going to be funding it, especially if you want to fund it with something like real estate. That's going to be really difficult to do. In the beginning, I would say you're probably going to fund it with cash until they've built up enough to where they can actually get to that point. Now, how does it get funded? In order for a kid to be able to have a Roth IRA, they have to have earned income. So they have to be paid for services that they're doing. And that kind of goes back to the pay your kids thing. If you have kids who really are working for you and you've paid them $12,000, they could take 6 of that 12 and put it into a Roth IRA. Nothing wrong with that. That's textbook really, really good strategizing. So, the answer is yes. The answer is yes, but in order to do it, they have to have some income, from some different sources. All right, this Secure Act 2.0. All right, people want to know about Secure Act 2.0, and that's a good thing because it's long, it's wordy. I'm sure like half of Congress signed it without reading it, and so for us, it's good for us to kind of break some of this down and make sure that we have a general understanding of what's going on. All right, so Ray wanted to know a little bit about Section 101, which is automatic enrollment in retirement plans. So this is kind of a simple little tweak, but when you start a job, let's say you start a job, and you ask about the benefits. What they're going to end up saying is, yeah, we offer health insurance and we have a retirement plan, but you could start getting into the retirement plan after you've worked here for 3 or 6 months or something like that. I've heard that over the years, is you have to be there for a little while. The way that this is set up, this automatic enrollment in retirement plans now, is that when you start a new job, if you work in a company that's over 10 people, they have to automatically put you into the retirement plan. They automatically say, hey, we're going to withhold 3%. And then what ends up happening from there is you have to go opt out and get out of it if you didn't want to be part of it. So it's a tweak. It's just saying, hey, we're putting everybody into the plan. From there, you gotta do a little work to get out of it. So the idea there is, if we end up making it kind of automatic, then maybe more people will participate. Apparently, there's some kind of study that says more people will participate. So, there you go on that. Another one that's pretty big that people are talking about is just this increase in age for required minimum distributions. It used to be 70 and a half. Now it's 72. So 72 years old is when you have to start taking money out of your traditional IRAs and taking RMDs, required minimum distributions. So, my older crowd gets a little bit of a break on that, and out of those retirement plans, don't necessarily have to take those out right away. All right, let's look at Section 109, which is catch-up contribution limits. Some questions about that. So catch-up contribution limits, typically have been that you're able to put more money into your IRAs at a certain age, and that is because you're about to retire soon. Maybe you're in a better financial position or something along those lines, and now you can put more money into it. So instead of your normal IRA limits, which are like 60, they change every year, but it's always around $6,500. You're able to do more on the catch-up contribution. So now, when you get to 50 years old, you're able to make catch-up contributions. So, they push that 5 years. It used to be 55. And so all the retirement plans are a little bit different, but having the ability to be able to do that at an earlier point, age-wise, is kind of what they're doing with that. Kind of something that makes sense. Personally, I think you should be able to put as much as you want into a retirement plan. But, that's just me. All right, let's see. What else we got here? All right, Shelly's here. Hey, Shelly, welcome. All right, I'm trying to decide if I should put money into a traditional IRA or Roth for 2022. What is the tax benefit of putting money into a traditional IRA for 2022? This is a great question. This is already a question that I've dealt with within the first 20 tax returns that I've done this year. So what ends up happening with traditional IRA is that depending on what tax bracket you're in, you get a deduction for contributing to a traditional IRA. So you could put up to 7,000. Let's just say you could put up to 7,000 in it, and let's say that you're in the 35% tax bracket. You take 7,000 times 35%, and that's your tax savings. All right, so like what it always comes down to at this conversation of traditional versus Roth is it's like, okay, if you need and want a tax deduction right now, then put money into the traditional. But if you don't want to pay, if you're okay with paying taxes right now and you want that money to grow tax free, then a Roth is the way to go. So if you're allowed to contribute to a Roth and you contributed that 7,000, you wouldn't save the $2,500 or the $3,000 that in taxes right now. But don't necessarily get hung up on $2,000 or $3,000 right now. What if you put that 7,000 in, and in 10 years it's worth 30,000? When you get to retirement, you are going to be able to pull that $30,000 out tax free. Okay? And so I go back and forth on it. Like, I can see a scenario where people are like, you know what, I'll take the tax deduction right now. I don't know if the money's going to go up or down in the future, so I'm not going to bank on that. I'll take my tax deduction right now, especially if you're in a high tax bracket. Other people might think, hey, the market always goes up. I have a long time before I get to retirement, so the money's probably going to grow. And so when I'm 65, I don't really want to pay any taxes. So really, it's just kind of what your preference is and what you think is going to end up happening. If you're young, if you're really young and you're like, hey, I'm going to be committed to this over the next 30 years, I think the Roth IRA is the way to go. As long as you can contribute to the Roth, that's a great idea to do that, because over a 30-year period, that is going to grow. But if you're 55 years old right now and you're like, hey, I want to retire in 5 years and I'm going to have, a government pension and, we have a bunch of money in a 403B plan or something like that, maybe you're not necessarily going to need that IRA money. And so, that is something that I think is kind of just maybe some of the thoughts that, we're taking into consideration there. So, I don't know. Let me know if that's helpful to you. I think I probably just gave you hey, well, that sounds like a coin flip, to me. But, probably lean towards just doing the Roth if you can afford to pay the taxes. All right. All right, let's see. When does the net investment income tax apply? The net investment income tax, for anybody that doesn't know, is when you are high income, married, filing joint, over $250,000, you get an extra tax on your interest, dividends, capital gains. All right? And so that's kind of it's an extra little it's a 3.8% tax. And that was part of the Obamacare tax plan from about 10 years ago. So interest, dividends, cap gain, rental income, income from businesses that are involved in financial trading, things like that. That's what is part of the net investment income tax, and it kicks in at $250,000. So, an example of that would be if you have W-2 income of $300,000 and then you have $100,000 capital gain, you're going to pay an extra $3,800 in tax with the net investment income tax. Really good question there. All right. Okay, Al's a good investor and gives the advice here. I like this. Thanks for kind of popping that in here. And again, you know what? if I'm talking about something here, I'm giving a short 2-minute condensed answer, and you think that there's something that's worth saying, I want you to pop it into the chat there, because like the idea behind this is community, and you guys are smart too, and I'm not the one that knows everything. So Al, I appreciate this comment a lot. If you have a Roth IRA and you're kind of like, I'm gonna invest in some risky stuff, maybe you found a stock that's worth, it's $2 right now, or something like that, and you think it's gonna blow up. If you put 10 grand into that, and you have a Roth IRA and it goes up 10 times, now you have 100,000 in your IRA that you don't have to pay tax on. That's a really, really good comment if you're into that type of stuff. Really, really good question. All right, how do I take advantage of the QBI deduction? The QBI deduction, for those of you that don't know, is the qualified business income deduction that was part of the Trump tax plan. What they ended up saying, if you're in business, and there's a lot of rules to this, but if you're in business and you have $100,000 of business income, we're going to give you a qualified business income of deduction of 20% of that. You get a 20% deduction, $20,000 comes straight off. All right, free, like just a straight deduction from the Trump tax plan. The idea behind that was to reward small business owners and give them some flexibility that way. How do you take advantage of it? There's two different types of rules that comes along with this qualified business income deduction. Side number one is if you're in a service business. If you're a doctor, if you're an accountant, if you are in like just your normal service type stuff, there is like you're under the service side of these things. Now, they might have adjusted it for inflation, but it used to be, in order to qualify for this, you had to make under $415,000. There might be a couple little inflation adjustments to that, but if you were under $415,000 in income, then you were going to qualify for the qualified business income deduction. Now, the other side of services is just your normal businesses. It's going to be manufacturing, retail, coffee shops, like all that kind of stuff. These are your kind of just regular, normal businesses that we see, basically non-service businesses. Those rules are a little bit different. You can make over $415,000 in those businesses and still qualify for the qualified business income deduction. So, definitely a great deduction. I mean, like I'm a small business CPA, so I have a lot of clients who make, between 50 and 400,000, and so what I was seeing is if you made 300 grand in your business, you get a $60,000 deduction. That's like the difference between, like, you can now hire another person, or you can give good bonuses every year. It makes a big difference. And so this was a really, really cool deduction. And, if you're over 415,000 and you're like, how do I qualify or take advantage of the QBI deduction? There's a couple calculations that have to do with the wages that you're paying to other people and the amount of assets that you have. And so it still is possible to receive that. We've done some planning on that and making sure people get it. One little thing that we've done some planning on, and this was a cool little tax tip, is let's say you're like an optometrist and you have a service side of your business and you have a retail side of your business. What we did with a couple people, because they were making over 415,000, is we had them kind of redo their books to show us the two business lines. What comes from the retail side, what comes from the service side. And in doing that, now you can go through and say, okay, we're going to take the qualified business deduction on this piece of it, and there'll be a piece of it that we don't qualify for. And so we were able to kind of like bifurcate some people's businesses between services and retail, and still give them an opportunity to be able to take the deduction. So many tricks, so many things that we can kind of look at. Having conversation about this stuff, coming to this kind of stuff is super, super important to that. Becoming part of my prosperity society, where I do videos that kind of break down some of these tricks, is huge. And so I encourage everybody to jump into that. We are posting about 2 to 3 videos a week that are just focused on a bunch of these little tricks of the trade, a lot of these questions that are coming up. And in doing that, it's all about being educated, guys. I promise you that this is time well spent. I really, really appreciate you guys being here today. Feel free to continue to ask certain stuff. I know like there might be 1 or 2 little things that I didn't necessarily get to here, but I will and will continue to talk about stuff. I appreciate you guys so much. Thank you so much for the time, and looking forward to a really, really good tax season this year. Thanks so much.